Hey, how's it going, guys? Welcome back to the Capital Mindset Show. We're going to be doing another subscriber request. This time it's American Sports. What is it? Yeah, Academy Sports and Outdoor, sorry. And this is a subscriber request. I made it to the top of the list. So we're going to be covering, as per usual, the price action first. And let's take a look at it over here. So for those of you who don't know, Academy Sports Group, it's an outdoor retailer. Okay, so basically, you know, for your sports stuff or your hunting stuff, kind of, if you get what I'm saying with that. Okay, so you know, you get your fishing equipment, all that stuff. Anything that is outdoors and sportsy, you can get it here at this store. All right, we're looking at a $2.8 billion market cap, and according to Google, it's about a PE of 5. So it looks very cheap on the surface, just on a quick glance. And taking a look here, it looks like they quite benefited from the pandemic, right? They actually IPO'd around here, October 2020, and they roared up about 285.99%. And then we see a drop, so about 35% drop from all-time highs. All right, so that being said, what's it looking like in the future? Now, it looks cheap. I'm going to take us over to the investor presentation, and we're going to get an idea for the actual underlying business, what they've shown us so far. Okay, so looking here, their revenues have grown quite nicely from 1.2 billion to 1.7 billion. Gross margins are increasing as well. So that means, again, they're able to charge higher prices relative to the cost of those goods. That's what gross margin entails, right? Because it's all it is, it's revenue minus cost of goods sold. And so we want to see that, but remember, it's indicative that we went through a pandemic where everyone's trying to buy stuff. So will that continue? I don't know. Comparable sales, this is comparing the same store sales from previous years. So this is the 8th consecutive quarter of positive comparable sales. So taking a look there, it's a 27% increase in 2020, 11.4% increase in 2021, with a negative 3.3% from 2019. But remember that they could make up for that by having new stores, as well as we can consider the peripherals, such as e-commerce, which they probably, if I had to guess, are going to tell us that they did. All right, so pro forma adjusted income, you know, it's up and to the right. Pro forma adjusted diluted EPS up and to the right. Like to see that. Taking a look down here. Okay, there it is, .com growth. So .com growth versus 2020. We are down a little bit, just about 1% from 2020. However, comparing it to 2019, we're up 207.2%. So we can see that a lot of the growth for this business is actually coming from those that change to the online peripherals, right? And so that's very important when we're thinking about a retailer. We want to make sure that they're keeping up with the times. And, you know, online business is actually the new way of actually attacking more customers, because, you know, the store is typically supposed to be located in a convenient place, right? So I go to the store, it's located in a convenient place. I like to sometimes look at the product. So for those consumers, we want that option. But some people don't want to do that. They want just convenience from their home. So they want to go on their app and just get it like that. And right here, you can see that they launched a mobile app. I personally don't have experience with this mobile app, but it'd be very good for, if you're considering investing in this business, to get familiar with this mobile app and see what it is that they're offering in terms of convenience to the consumer, right? And I imagine, since it is a mobile app, it's quite convenient, you know, just order things from your phone. Okay, so if you have kids and your kids are involved in sports, this company is probably targeting someone like you. Okay, sales penetration 8.4% in Q2 2021 compared to 4. Okay, so that's, I like that. Let's go down here to this. Company raises fully. Okay, so their forecasts are going up. So everything seems to be firing on all cylinders. That's the feeling I'm getting. But we have to remember that this is the sales pitch of the business. And then that's a little bit of fluff. But I like it. They don't have too much fluff in here. They're really straight and to the point, which I really appreciate, actually, for a business to do. Because I don't like it when I see a lot of patting on the back slides. And when they say, oh, look at us, we're so good. Look at us, we're such good people, stuff like that. I don't really like to see too much of that. I really like it when they're just, here we go. This is our business, this is what we're doing. This is what we're guiding for. Awesome. Here you go. Done. Now let's take a look at their balance sheet and kind of get a feel for what it is that's going on. I'm going to go from top to bottom. So we look at cash. Cash is about $401 million. It is down from 2020, October 31st. I'm ignoring January 30th. I'm just going to compare it to 2020 of October and looking at 2021 October. Okay, so Their merchandise, their inventory, we want to keep an eye on that. They actually are managing it quite well. We've noticed in other stocks that we've been looking at, they had a little bit of trouble with the inventory, but we don't really see that here. So they've been doing pretty well on that said. Property and equipment. Okay, so their right of use assets is fine. Trade name. Okay, so these are starting to see some intangible assets. So the intangible assets, that's the name of the company. And they assign a value of about 577 million, and then goodwill of 861 and 920 million dollars. Okay, so I ascribe very little value. I don't really like to consider that when I, for example, will take a look at the tangible book value. I'll eliminate those. But yeah, we can kind of see that a big chunk of their assets, over $1 billion, about 1.3, $1.4 billion, is attributable to these non-tangible assets. We don't really know exactly what the value is, but these liabilities down here, these are actual tangible liabilities. So these are accounts that they owe. And we look here at the long-term debt. They're about sitting at 683. We just want to make sure that, oh, look at that. It's actually coming down. I like to see that. Wow. Okay. So this is actually intriguing from the sense of how they're operating this business. They are paying down debt like crazy. That's over half, right? They cut this debt in half. So I applaud them right off the bat. I have to say, they made a huge payment between 2020 and 2021 right here, because that's January 30th, and you can see they're already down to 781 million. Then they slowed it down, but wow, they paid down a lot right there. I imagine that they used the IPO money, because usually when they pay down like that crazy, that's probably where it comes from. Let's take a look over here at the net income. So yeah, gross margins look pretty good for a retailer. Yeah, that's actually pretty good for a retailer. They are on the rise. We know that from the presentation. And then let's look at the operating income. Okay, so that's fine. Let's look at the cash flows. Cash flow statement of cash flows. There we go. All right, so operating activities produced 515 million and CapEx of about 58. So pretty good. Operating activities actually are in decline though. So if we can identify with our eyes what happened, actually it is inventory related. So right there, they are spending a lot of money on inventory right there. So it's a negative 335 print. The net income is much higher for 2021, right? But again, since cash is leaving the business right here, that's actually what's causing it. It's merchandise inventory. I like it that when I just click this, it highlights the whole thing. It makes it really easy for my eyes, right, to just pop it over there. So yep, that's nothing else out of the ordinary here. That's absolutely crazy. CapEx is rising, but that's not necessarily a bad thing whatsoever, because I want them to reinvest back into the business. All right, so I think from here, let's actually go over to the model and kind of discuss what we can find out with the model. Ignore the growth rates. Actually, I'll remove this discount rate to put it to 10%, and we're going to put this to 0% because I don't want to assume that. And let's go for it. ASO. Let's see what we get in return. All right, so right now there's no price targets that's porting in, so we'll just ignore that. We do have analysts rating it as a strong buy. Let's go over here. Now you guys can pause the video here and take a look at this with their when they were born, the gender, and the pay. Okay, and taking a look down here. Again, since they just IPO'd, I think they IPO'd again in 2020. We only have the data for 2018 and above, so we need more data to kind of get a bigger picture of the longer term. But we do see that analysts estimate cash flows to actually decline this year versus last year. And we are actually seeing that already. So we are seeing that decline there. And looking down at the revenue is still expected to rise. Okay, so that's good to know. Cash flows, I think, will normalize once they get past the inventory. So the inventory thing is kind of a problem that they are dealing with. And looking at the share count, it's fluctuating, but we know I don't really care about these 2 years because they weren't public. So if they are buying back some shares, that's fine and dandy. But we won't even consider it because we don't really have enough data to really know about that. Okay, but they are trading fairly cheap, even on a cash flow basis. So the market might be pricing in that they're not going to maintain these cash flows, or the market just completely overlooking this company and thinks it's, I don't know, going to die or something. Okay. So Looking at the Altman Z-score, it is rating it at a not in risk for bankruptcy. And then the model itself is saying, no, it's not at risk of bankruptcy. Taking a look at the book value, we have a $15.10 book value. But when we remove those intangible assets, we get about a 4.19, negative 4.19. All right, let's take a look at the key ratios, get an idea of the balance sheet, and see what we can see. So again, we don't have this data, so we're going to ignore that. And we're going to just look strictly at 2019 to 2021. So the liquidity ratios, they look pretty good. Looking at the current ratio, it is getting worse, but it's still pretty good. It's above 1. Then the solvency ratios is what it should be getting better, because when we saw the debt coming down. So the long-term debt ratio, it is down from 2020. So, and it is, well, that could also mean because some other things have also changed, because it is a relationship between long-term debt and other parts of the balance sheet. So long-term debt to capital, debt to equity, we are seeing it's about the same. It's about the same. Gross profit margin, we saw this from the presentation. It is on the rise. Operating margins are also on the rise. Net profit margins on the rise. ROA, ROE also on the rise as a result. Okay, taking a look over here, let's actually take a look at the earnings quality. Earnings quality is actually really solid across the board in every year that is measurable. And let's take a look at the cash conversion cycle. Cash conversion cycle was, I expect this to normalize. These are pretty crazy cash conversion cycles for this business, but it's fine. It's nothing that I would actually highlight and say, hey, okay. Let's take a look over here. And remember, we don't have anything porting in as far as the earnings transcript goes, but we have all these recent articles posted. And I think there's a last 10 articles posted. I can put more, but I think it's overwhelming to put more than that. So I only poured in the last 10. So we can kind of read some of these and see, okay, what is the sentiment? And I actually am working on the sentiment measure, but that will be separate and that'll come later. So they are included in this article, for example, 5 undervalued. So that's investors' place. And Zacks is always showing up, Zacks is always writing stuff about stocks. Best value stocks, forget profit, rising cash flows. Okay, so basically Zacks is like super bullish, I guess, or they're just writing clickbait articles about it. Academy Sports Outdoors, what you should know, 4-star. Okay, cool beans. And we got to pay attention to the dates over here. So they're actually fairly recent in February. We are in March. The date is March 3rd, 2022. So, all right, so let's go over here and start valuing this thing. So I think with a 10%, that implies that we just understand this business and we can see that it's very cheap. I think we're pricing in some sort of decay. So let's see what kind of decay we're at. And I think the market, let me see what the market is saying at this current fair value. So the current price is 32. So we're probably pricing in some crazy decay. Yeah, so around a 20% decay in cash flows. That's what the market's kind of pricing in at the present moment. And no, that actually might happen. Don't think that just because it seems outlandish that, we have the bias of recency or recency bias. So just because they grew a lot doesn't mean that they won't decay, but the market is pricing that in. I'm not saying that efficient market hypothesis is, correct or completely correct or is without fault. But, that's about what the market's pricing in. So if we start discounting it at a higher rate, right, we require a greater margin of safety. Well, now what we start to see is we can't assume this rate of decay anymore, right? But it's still incredibly cheap. So let's actually discount it again at 20%. And you can see it's still incredibly cheap, 25%, still incredibly cheap. I'm trying to make my point here that this company is just crazy cheap, right? It looks cheap. It feels cheap. It is cheap. Okay. So let me see how far I can go with this. We've seen companies like this in the past, and there's always something about them that is the reason as to why. So what this would probably require is a lot more research as to why it's priced so cheap, right? And I think it has to do with again, getting back to normal, the normalization fear. So if it ends up coming back to normal or coming back down to earth, we may experience, or we may find out that it's actually kind of fairly valued, right? So, or this is just a very cheap stock. It's one thing or the other. Okay. So I think for that, I would say you guys can comment down below what you guys think. if you guys are invested in this, one of you actually was the one who requested this. So if you guys are invested in this, go ahead and share your thoughts and then let the community know. And then everyone can provide feedback to one another as to what they think about this stock in particular. So I'm just highlighting the stock to you guys. It's not something I'm going to be investing in because it is in the sector. I've been covering a lot of the sector that I just, it's not my specialty. Retail is just definitely not my specialty. However, I do see that, someone out there who likes these kinds of businesses might understand this business in particular and might say, okay, well, the market's pricing in decay, but it's not going to decay. It's going to stabilize, normalize. They're going to return a ton of capital to shareholders, and I'm going to make a lot of money, right? So then that's also the perspective. On that note, guys, I think I'll end it there. And if you guys enjoyed this video, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe, and then you come back to the show, and then we have a video of a stock that you're looking into. And you guys have any requests, go ahead and comment down below. And if you guys have any questions or things I missed out, go ahead and comment down below, and I'll try to get back to you guys at a reasonable time. All right, guys, I'll see you guys in the next one. Bye. Oh, actually, one more thing before you guys go. I forgot to mention that in this video, the cash flows being utilized for the analysis was using the 2021's numbers, and that in 2020 we did see the decay. So that's actually the reasoning or the basis as to why I was saying the decay is happening. And remember, we're seeing the decay because of the inventory. So I actually wanted just to clarify that the decay in cash flows might actually be a reality. We don't know to what extent, but just again to highlight that the company looks extremely cheap, but we have to be aware as to what the market's kind of trying to tell us, right? So the market's not super stupid, right? It's not even stupid, but the market tries to tell us things with the price, right? So a lot of investors have all this access to this information, and they're all making the decisions as well. So what the investor base is actually probably saying is there's something else going on here, and that's why it is so cheap. Now, I also want to highlight, I didn't get into too much detail, but regarding the debt or the obligations, it's actually the debt or the total debt, we could say, or total obligations are actually quite high. They're over $1 billion, and that's again obligations. We're kind of going beyond what long-term debt is, and typically with retailers, when they have all these other liabilities or obligations that they have to pay, they typically tend to be really high, and we do want to consider those as some form of debt, right? Because you owe that money. That is an expense that must be paid. For example, lease liabilities. Those lease liabilities for the actual facilities are in the form of debt, right? Because you have to pay that rent. Okay, so just wanted to add those few little tidbits here and there at the end. And again, hope you guys enjoyed the video, and I'll see you guys in the next one. Bye.